Thank you everyone for joining us for our monthly presentation on year-end financial planning. My name is Sophia Sakamoto, and we're so glad that you can make it today to join us. We will be discussing ways to plan for the end of the year. And gosh, what an unforgettable year it's been, 2020, so crazy. But we are going to be talking about some financial things you can do from the perspectives of a tax accountant, a financial advisor, and an estate planning attorney. What financial planning strategies should you implement before the end of the year? What were some changes in the tax law that could affect your retirement or investments? And just ways to plan and what to do. That's what we're going to be covering for today. Today's presentation will be presented by Yuri Yu. She is a certified public accountant and her office is in Fullerton, California. Donna Lee is a certified financial planner and her office is located in the city of Orange. And I'm Sophia Kim Sakamoto. I'm an estate planning attorney, probate and living trusts. We have offices in Buena Park and Mission Viejo. If you have any questions, please go ahead and type them in the chat box below. Time permitting, we will try to get to answering them at the end of the webinar. Please note this webinar is being recorded. You probably had a little pop-up before you came in to the presentation. And just a quick disclaimer, this is just general information. We're not giving any specific legal or tax advice. If you do have any questions, you should talk with your trusted advisors. There's no attorney-client relationship being formed here. And please do not record or take any screenshots. If you do, please ask for our permission first before doing so. All right, and so let's get started. Yuri, I know that you get a lot of this and I'm sure your clients are asking, you know, the end of the year is quickly approaching. What can we do to lower taxes and what should we do for the year end?
Yeah, so let me start with what tax planning really is. Tax planning is when you analyze your financial situation from a tax lens and you're just looking for opportunities or strategies to reduce your overall taxes. It's really helpful in years your income is higher than usual, like you have some sort of windfall, like a really big bonus or a gain on the sale of a home or stocks. But it's also helpful in years where your income is a lot lower than usual. So these are some of the strategies that can be used when you're doing tax planning. You can accelerate or delay income or expenses. If you're able to recognize income in those lower tax rate years and you take deductions in higher tax rate years, then that helps you lower your overall tax liability. You can also try to time the sale of assets to make sure you're taking advantage of lower tax rates, whether it's capital gains tax rates or a lower ordinary tax rate. Or if you're selling stocks, you know, you can try to make sure that you're not selling so much that it's pushing you into a higher tax bracket. Budgeting for your tax liability is another really good reason for tax planning, especially in a year you know you're going to owe taxes, just so that you know how much you should be putting aside. Or if you regularly get big refunds or you owe a lot of tax with your returns and you're an employee, you might want to do, adjust your withholding allowances, which adjusts how much taxes they take from each of your paychecks, just to make tax time a little bit less stressful and that your tax liability is kind of being, paid throughout the year and you're not, you have all this uncertainty when you do your return in April. And this last one is a big one. It's to prepare for changes in tax laws. It's no secret that tax law changes are coming, and it's pretty likely that taxes will be going up overall. If not soon, then in 2026, after the tax law changes from 2017 expire. If you've listened to our webinars, I've said almost every single time that tax rates are historically low right now. So we know they're going to go up anyway. But some of that depends on what happens in the runoff election in Georgia in January. That's going to help us know whether changes are going to be coming sooner rather than later.
So Yuri, with all this uncertainty, do you think people should even start doing estate planning? I'm sorry, not estate planning, tax planning. I mean, do you think should I do it now knowing that it'll change next year?
I mean, I think so, because even though we don't really know exactly what's going to change, we kind of have an idea of what's going to happen. Like, we know that it's very likely that tax rates are going to go up. Some of the things that were discussed were increasing the top individual tax rate, the capital gains tax rate, payroll tax rate. So like pretty much everything out there. Some of the things that might lower your taxes are like increasing tax benefits for childcare and having like energy efficient products. It's been said repeatedly that taxes are only going to go up for those making more than $400,000. So maybe it's not going to affect everyone, but if you have a windfall coming, or you have like an asset that's gone up a lot in value, or just anything else that makes your tax situation a bit complicated or uncertain, it's probably a good idea to consult with a CPA or other tax professional just to see if there's anything that you should be thinking about and planning for right now.
I'll just interject a little bit. Part of tax planning is obviously trying to predict what's going to happen in the future, but part of it's also taking a look at what happened this past calendar year and how it'll actually impact your taxes. So from a financial planning point of view, financial advisors, we do this all the time. A lot of the money managers we work with do this as well. We do tax loss harvesting. So if there were maybe there was a holding back in March where the market went down a lot, there was a sell. If things have gone up, we can offset that gain, offset the gain with the loss and sell it in that same calendar year, wait 31 days and repurchase it again. So it's a lot of, it seems like a lot of transactions, but it's all done from, you're basically harvesting your tax losses so that you can maximize those losses.
All right, great. So Donna, I'm sure you get this a lot from your clients then, and it's already mid-November. Do they ask you, what financial planning strategies should they implement before December 31? Is it too late? Like what advice can you give them?
Yeah, absolutely. So this is the time of the year where we're talking about ways to make sure we're maximizing our deductions or maximizing the retirement accounts. That's a big one that usually comes to mind. So why is it important to maximize your retirement plans? Number one, obviously, is to save for retirement, probably the largest financial goal any one of us will ever save for. And also, you have the potential to save on taxes. So if we can kill two birds with one stone, let's go for it. The IRS limits for this year's salary deferral for any group plan, so this is any like 401k, 403b, 457b, solo K, any group plan is $19,500. If you are over the age of 50, then you also have an additional catch-up. You can do an additional $6,500 on top of that $19,500. Note that this does not include employer contributions. Sometimes I get questions like, oh, well, my employer matched 3%. Does that mean it offsets what I can put in? No, the $19,500 is the amount that you can put in through your salary deferral. When we're talking about individual retirement accounts, we're looking at traditional IRAs and Roth IRAs. The difference between traditional IRA and Roth IRAs, there's a couple of differences, but the biggest difference is when money comes out of these plans. When money comes out of a traditional IRA, it will be fully taxed at income rates. When money comes out of a Roth IRA, there is no taxes at all from an income tax point of view. So the IRS has limits for these as well. The limit for 2020, the contribution limit is $6,000. If you're over 50, then you can do an additional $1,000 to make it $7,000. The $6,000 that you can put in, it doesn't matter if you want to do $3,000 in traditional and $3,000 in Roth, or you want to put all $6,000 in one or the other, or however you want to split it up. But just note that you cannot do $6,000 in one and $6,000 in the other. This only applies to contributions. So if you did any conversions, any transfers, any rollovers, those do not apply. You must have earned income to contribute. If you think about it, it kind of makes sense. You must have earned income. You must have worked to be able to retire in a retirement account. So you must have earned income. Passive income does not count. There is no age restrictions on contributions into your traditional or Roth IRA. This was removed earlier this year. There used to be an age restriction, now there isn't. So as long as you have earned income, you can contribute. Most of the time, people think of IRA contributions as deductible. And while that is true, for some people, it's not always true. There is a big asterisk by that. And it depends on your income, and it depends on if you are considered an active participant in a 401k plan. So even if you have access to a 401k plan at work, but you don't use it, it's possible that that could affect your IRA deductibility. So make sure you talk to your CPA to see if your contributions are even deductible at all. Roth IRA, you can only contribute if you're under a certain income. Whereas the traditional IRA, you can always contribute as long as you have earned income, you can always contribute. It's a matter of whether it's deductible or not. In a Roth IRA, you either can or you can't based off of your income. So here's a tax table based on your filing status on what that limit is. It's a lot of numbers and a lot of words. So I'm just gonna explain like the married filing jointly real quickly. How I see it is 196 and 206 is the cutoff. So if your income, if the married filing joint income is under 196, you both, husband and wife, can both put in the full 6,000, the full maximum contribution. If the income on the tax return is over 206, then neither of you can put in anything. And if it's somewhere in between 196 and 206, then it's going to be a reduced amount. So to make my math easy, let's say your modified AGI is right in the middle. It's at 201, right? It's right, it's 5,000 from both sides. So you're right in the middle. That means both of you can do half of the maximum. So $3,000 per person.
Great. So just to clarify, the 6,000, is it per person?
Yes, that's a great question. It's per person. So IRA stands for individual retirement account. So it's per person. There's only one owner on there. So if you want to open a traditional and your spouse wants to open a Roth, that's fine. Solo case. This one is a little bit of a unique retirement account. It's technically a group retirement account. It's set up through a group, except the group only has one person. Sometimes you'll hear it as an individual K or an individual 401k. This you can set up as long as you are self-employed. You're self-employed, but it doesn't matter how your entity is set up. You could be sole prop, you can be incorporated, you can be LLC. It doesn't matter. As long as you have self-employed earnings, you can set up a solo K. The major rule is that you cannot have any employees. So that's why it's solo, okay? Other than immediate family. So you and your spouse have a business together, that's perfectly fine. This is where the year-end planning comes into place, is you must set up the account by the end of the year to contribute for the tax deferral, for the salary deferral portion for that calendar year. So that $19,500, if you want to put it into the solo K, the account must be set up by 12/31/2020. We're already in November towards Thanksgiving, so really we have maybe 2 or 3 payrolls before the end of the year. If you want to put in $19,500 into this plan, but you only pay yourself by, I don't know, $3,000 a payroll period or so, consider bonusing yourself. So we talk about this a lot with business owners, is to adjust their income to see if it makes sense to consider bonusing yourself to maximize the salary deferral portion. And then since we're talking about the salary deferral limits, just know that in the solo K, you can actually contribute above the salary deferral limits. That is one of the beauties of this plan. So if you're self-employed, just know that there's a lot of options available to you that wouldn't be otherwise. Backdoor Roths is a big one that we do towards the end of the year. So here's the common problem in Southern California. You and your spouse, you do married filing joint on your tax return, you make $300,000 and you feel like you cannot benefit at all from an IRA or a Roth IRA, right? You know, oh, IRA sounds good, I could get the tax deduction generally. But the problem is you cannot, because you make too much money and you cannot get a deduction on that IRA contribution. Well, then maybe I'll do a Roth IRA. Well, the problem is you cannot, again, because your income exceeds that IRS limit. So for families who make in 300,000, for example, they feel like they cannot benefit at all from an IRA or Roth IRA. But here is a potential solution. Can we go to the next? Yeah, here's a possible solution is a backdoor Roth, or what I call a backdoor Roth. So essentially what you do is you contribute the maximum for that tax year. So in this case, it'd be $6,000. You contribute it directly into the traditional IRA, because remember, you can contribute into the traditional IRA, you just won't get a deduction, okay? And then step two, you convert that immediately over into the Roth IRA. The key is to convert it immediately, so you're limiting gains and you're not paying very much in tax, if at all. And then once the money is converted over into the Roth IRA, yay, the funds are in the Roth IRA. You never have to worry about taxes again. We essentially avoided that roadblock number two because we did not contribute directly into the Roth. We had to go through a backdoor way into the Roth. So this is just one strategy that we use a lot with our clients. This is a good example of what financial advisors do. We take all these tax laws and tax regulations and we find ways to put them together. We play chess and make it work, essentially. But this is just a possible strategy. It doesn't work with everyone. It is a little bit complicated from a tax standpoint, so make sure you let your CPA know if this is something that you're thinking about doing.
Donna, I know that you probably talked about this in the other slides, but why would somebody want to convert a traditional to a Roth IRA?
So the main difference between a traditional IRA and a Roth IRA is when you take the money out. So in a traditional IRA, every dollar you take out of that account, you will have to pay tax on, income tax on, unless you contribute it into a non-deductible IRA. Remember how we talked about it's possible to do, then you're paying tax on the gains, okay? Whereas in a Roth IRA, every dollar you take out, you never have to pay taxes on. So a Roth IRA, in my opinion, is actually one of the most unique accounts out there because it is an account that you fund with after-tax dollars, but that's it. There are no more tax strings that apply. And once the money is in a Roth, you never have to worry about it from a tax standpoint. So that could be very freeing for some people, never to have to worry about taxes. And you're never at the mercy of the IRS and whatever tax rates are going on in 20, 30 years later. Another thing that we look at a lot at the end of the year is possible Roth IRA conversions. So same thing, same reasoning applies where some people, they have some money in their IRA or pre-tax accounts and they want to move it over to the Roth to basically stop that tax ticking time bomb, essentially. And so instead of waiting until they retire and taking money out of the IRA at that time, they start to move it over to that Roth slowly over the years. So remember that whatever you convert that calendar year will be taxed in that tax year. So if you convert 10,000, it's as if you made $10,000 more in income. A couple of things to note is your tax bracket. So make sure you know where you fall in the tax bracket. You don't want to convert too much and bump you into the next tax bracket. Roth eligibility, make sure if you are making Roth IRA contributions, make sure you're not converting too much and then you cannot make the contribution anymore. Medicare Part B premiums, in I think our last webinar we discussed this, or maybe 2 webinars ago, where you don't want to convert too much and it might increase your Medicare Part B premiums for those that are paying into Medicare. You want to take a look at where you are in the market cycle. If the market took a really big dip, say March this year, that would have been a great time to convert some IRA to Roth. When the market is high, it's not as advantageous. And then lastly, want to kind of have an idea of what your future income looks like and future tax rates look like. If income is going up and tax rates are going up, it might be in your best interest to convert now rather than later. And then since we're talking about retirement limits 2021, I'll just put it out here that all retirement contribution limits are the same as 2020. The only difference is some of the phase out limits have increased a little bit. So as usual, my suggestion for those that are maxing out their 401k plans, 19,005 divided by the number of paychecks, just set it up with your HR so that you can automatically max out by the end of the year. One last thing that I don't have a slide for that I will mention that can be done by the end of this year specifically, if you want, it has to do with the CARES Act, is distributions. They're generally speaking, when you take money while you're still working and you're under 59 and a half and you're taking money out of a 401k, you're going to pay taxes and penalty. However, because of the CARES Act, you can actually take out up to $100,000 this year, only up until 12/30/2020. I don't know why it's not 12/31. Maybe it's a weekend, I'm not sure. But if you want to do this, you can only do this up until December 30th of this year. The normal 20% withholding and the 10% early penalty tax can be waived. So that's unique, but the distribution, however much you take out, will still be taxable. Something unique is that tax can be spread out over 3 tax years as opposed to 1. So maybe it'll minimize the chance of bumping you into the next tax bracket. And here's the kicker is if you put the funds back within 3 years, and you're going to have to file a tax amendment, but you get your taxes back. So this is kind of a caveat that is unique to this year only because we had such an interesting year with coronavirus. But if this is something you want to do, you have to do it by 12/30 of this year.
Good to know, and even more reason to talk with a CPA or financial advisor about things to do for the end of the year. Just want to throw in about trusts. If you are a trustee, you still have to file a tax return for any income that the trust generated. So usually if someone passes away and now you're the one in charge to handle the trust, if there's any income, then you do have to file a trust tax return, but the trusts are taxed at the highest tax bracket. That's why tax planning will be important. Any of that liability could be passed on to the beneficiaries. And of course, at beneficiaries, they might have a lower tax bracket. So if you are a trustee, if someone had passed away, now you're in charge, you may want to also talk with your CPA, financial advisor, if you think that the trust will need to pay some taxes for this year. All right. Did you want to talk about this part as well?
I'll just say real quick, a lot of this is stuff that Donna already mentioned. Roth accounts, when you take out money, it's not taxed. But if you have the opportunity to max out your 401k through your work, even if it's a pre-tax contribution, there is a tax benefit for it today. So let's say you're in the 24% federal tax bracket and the 9.3% California tax bracket, which is like a married couple who makes like $200,000 or $300,000, and you max out your salary deferral of $19,500. That's tax savings of $6,500. And so that $19,500 contribution only cost you $13,000. And this is per person. So you're not going to feel this tax savings because it's not going to affect your tax refund because all the numbers and the taxes are kind of, figured out through your paychecks. But just know that whenever someone asks me, how can I reduce my taxes? The first thing I usually say is, are you maxing out your retirement? Because there are a lot of tax benefits for doing that.
Great. So I know that this year had a lot of changes. Donna and Yuri, you did discuss some of them previously, but more specifically, what kind of changes in the law this year affects taxes retirement?
Yeah, so everyone knows about the CARES Act, but not everyone knows about the Secure Act that passed. It passed just a few months before coronavirus hit, so that obviously took the spotlight away. But it did make a couple of big changes in the retirement account side. So we'll talk a little bit about that. It's already in effect, just so you know, it's already in effect currently. So number one, required minimum distributions have changed. Inherited IRAs and what beneficiaries can do have changed. We're going to talk a little bit about those two in depth a little bit more later. I mentioned earlier that they removed the age limit to contribute into an IRA. That's pretty easy and minimal. And then the last thing is employers now must include part-time employees that have worked at least 500 hours and 3 years of service. Now they have to be included into the 401k plan at work. So it's kind of nice if you're always, it used to be 1,000 hours a year. Now they've dropped that down to 500 hours a year, but you've been there for 3 years. So now you can have the option to get into the 401k plan. Let's talk a little bit more about the RMDs, required minimum distributions. Next slide, please. All right, so required minimum distributions apply while you're still alive. And it includes all pre-tax accounts and Roth 401k, which is a little strange, they throw that one in there. But the whole point of RMDs, required minimum distributions, is because remember, all pre-tax accounts, when the money comes out of the plan, you're going to have to pay tax on that, income tax for that. So therefore, the IRS is basically waiting to collect their taxes, right? They're waiting for you to take money out and collect their taxes. But if you never took money out, they will never collect taxes. So therefore, they put an age limit on that. It used to be at 70 and a half, and they've increased it now to 72. So once you turn 72, you're going to have to take a certain amount out of all of your pre-tax accounts, and that will satisfy your RMD. If you don't, there's a hefty penalty that you'll have to pay for that. Conversions do not count towards RMDs, okay? Inherited accounts are for deaths that occur, well, inherited accounts are for the beneficiaries, basically. The beneficiary who inherited an IRA. And the rules have changed for deaths that happened in 2020 and after. There used to be a lot more flexibility on how the beneficiary can take the money out of the IRA accounts. However, now the options are extremely limited. It's pretty much need to take it out within 10 years. So the beneficiary, that's it. The beneficiary must deplete the account within 10 years, but it can be done at any pace. They can do it 1/10 a year for 10 years. They can do 20% every other year. They can do it all within the first year, or they can wait until the 10th year and take it all then. Okay. The important thing is that in 10 years, the account must be completely depleted or there's a big penalty. If this was an IRA account, a pre-tax account that the beneficiary inherited, that could be huge tax ramifications, right? There are a few exceptions to this rule. So if you're a spouse, if you're a legal minor child, anyone who's disabled, chronically ill, or someone who's within 10 years younger to the decedent, maybe like a sibling or so. The legal minor child, once the child reaches the age of majority, then the 10-year rule kicks in. So essentially, by the time the minor child is 28, that account must be fully depleted. As you can see, this poses a lot of planning opportunities. So talk to your CPA, talk to your estate planning attorney. This is going to be a huge one with estate planning attorneys because a lot of times trusts were listed on as the contingent beneficiary on retirement accounts, or even primary in some cases. But the trusts may have to be rewritten based on the new tax rules. So this is huge. Please talk to your estate planning attorney to make sure that your trust is reviewed and it makes sense to be the beneficiary still of a retirement account.
Yes, and we have had to make some amendments to our prior trust. So this is definitely something to ask with your estate planning attorney.
So the big tax bill this year was the CARES Act. That was the Coronavirus Aid, Relief, and Economic Security Act. And so these are just some of the highlights from the CARES Act. Stimulus payments, everyone remember those. They're going to be reconciled on your 2020 tax return. So if you didn't qualify for one based on your 2018 or 2019 income, but you do in 2020, you'll get it through your 2020 tax return. There's no clawback provision, meaning that if you got it, but your 2020 income is higher, they're not going to take it back. So just make sure you know how much you received, because you'll probably need that number when you do your tax return. They also passed a $300 deduction for cash donations for those who don't itemize. Another random thing they threw in there was that HSA funds can be used for over-the-counter medications. As Donna mentioned, RMDs, I think Donna mentioned, RMDs are waived for 2020, so you didn't have to take a required minimum distribution. A big one for business owners is net operating losses incurred in 2018, 2019, or 2020. Those losses can be carried back for 5 years, and you can get refunds of taxes you paid in those years. This applies to ordinary income or losses like business losses and not capital losses. And tax rates were higher 5 years ago. So if you had, losses in those particular years, it's a good idea to look back to see if that would benefit you. And then some stuff with business improvement property. Yeah. Other things to kind of keep in mind for 2020, there was no penalty for not having health insurance in 2019, but starting in 2020, California is assessing their own health insurance mandate penalty. Unemployment benefits, this isn't new, but just something to keep in mind, because it's probably going to affect a lot of people this year, is that unemployment benefits, and this includes the pandemic unemployment benefits that was provided to independent contractors, those are taxable by the IRS, and there likely was no taxes withheld from those payments. So just make sure that you have some money set aside just in case. You'll receive a form 1099 from the EDD. So make sure you keep that in your files, because you're going to need it when you do your tax returns. And, like I said, there's more changes coming. I do monthly webinars with other professionals just to make sure that I'm, keeping current on those changes. So tune into our webinar in February, I think February 19th, and we'll update you on anything and any changes in tax laws between now and then.
Okay, great, Yuri. I also want to talk about one new law that just passed about 2 weeks ago, and it didn't make it onto our slides in time, but I'm talking about Proposition 19, which modifies property tax law. So the old law under Prop 13, it limited property tax increases. So property tax is what you pay to the county every year for any real property that you own. And that's why a lot of older California properties have a very low property tax than what the fair market value would be if you were to sell it in today's market. But Prop 19, which was just passed in November, like about 2 weeks ago, it modifies that existing law. The good thing is that it allows eligible owners, those who are over 55, disabled, victim of a natural disaster, they can move anywhere in the state up to 3 times. Before it was only 1 time, but now it's 3 times to a home of lesser value and bring their property tax assessment with them. So that's good because it helps the elderly and those who need it to maintain their low property tax. But it also modifies the law regarding inherited properties. So prior to Prop 19, if a property owner, usually parents, then they wanted to leave their primary residence or maybe like a rental house, some commercial property, they could leave it to their kids. If it's a primary residence, the parents' low property tax would also go to the kids. And for rental properties or like investment type properties, up to $1 million in assessed value could also be transferred, also qualifying grandchildren. But now it's a little bit different now. So it's only for primary residences and no other real estate. So you could transfer your primary residence to your child. They also have to have that as their primary residence. It cannot exceed the fair market value and the assessed value by 1 million. So your assessed value, that's what the assessor says your value is. It's probably going to be really low compared to what the fair market value is. It should be not to exceed $1 million, that difference. Then you can transfer that low property tax anything else, rental properties, commercial properties, that would face a reassessment to the fair market value at the time of the transfer. This takes effect February 16th of 2021. So if I'm dealing with a trustee, I'm sending out all these letters and letting them know, hey, you may want to make that transfer now. If you have something that's going from a parent who is deceased, they have rental property, let's make that transfer now before February to take advantage of the parent-child exclusion from property tax reassessment. Okay, so Yuri, I'm sure you get a lot of questions about business owners who may have taken out a PPP loan, and they're probably wondering, how can it be forgiven?
That's a really good question. I have PPP fatigue because there has been so much uncertainty surrounding these loans and the forgiveness process. You know, they were under a lot of pressure to get this money out quick, and then they kind of just did it and then wrote the rules later. But here's what we know today. You're gonna apply for forgiveness through your lender. Most lenders are going to set up their own platform for you to fill out the forgiveness application online. The deadline to apply is 10 months after the last day of the borrower's covered period, which is either 8 weeks or 24 weeks after the day the loan was funded. Easy, right? There are 3 forgiveness forms. Form 3508S for loans under $50,000. This is the easiest form. But not form 3508 easy for those that meet certain criteria. This is the second easiest form, and form 3508 for everyone else. The big controversy right now is, so as it stands right now, the expenses that you pay with PPP funds are not deductible. The IRS just doubled down on that. They released guidance, I think on Wednesday, reiterating that, since Congress says that that was not their intent when they wrote the law. So it's possible that that will change. There is bipartisan support for it. And it's unfortunate because this affects taxpayers and businesses quite significantly, you know, and it's hard to plan for that right now. But if you received PPP funds, just keep in mind that the expenses might not be deductible. And so just plan for that. And it's probably best to wait to file your tax returns until we know for sure. So hopefully we'll hear something soon on that.
All right, great. So, you know, I get a lot of clients who also ask me, like, what should I review? Should I review my estate plan? And the answer is, of course, yes. If you have a trust, you should go ahead and check those trustees and those distributions. Were there life events during this year that would change your distributions? Marriage, birth, death, disability? Did you get retired? Did your kids turn 18? Do you want to recheck some of those provisions? Go ahead and do that. I always say a good rule of thumb is to review your documents every 3 to 5 years. Are assets titled correctly? Do you have the trust as maybe a beneficiary? Do you have the trust as the owner? Go ahead and review that. Are your kids over 18? Do you want to make them the beneficiaries? Do you want to make them the trustees? Did you have some provisions in place about when they can get some assets? Do you want to make some changes to that? Of course, trustee tax planning as well. Like I mentioned earlier, if you're a trustee, you will have to file, you might have to file some tax returns and want to think about ways to do some tax planning on that. And in light of the rise in the COVID cases recently, you may also want to take a look at your healthcare documents, your healthcare directives, your living will. In the past, you might have said, you know what, no ventilators, no breathing machines, no intubation, no anything like that. But nowadays, you know, with the COVID being like an airborne type of respiratory illness, you may want to think, okay, well, maybe ventilators are okay, maybe intubation, maybe I need that, maybe I'm okay with some experimental treatments. And also because it could be that you don't see your physician face to face, maybe we want to say it's okay to email them the documents or communicate by email or like FaceTime, something like that. So just a good idea to review your healthcare documents. Make sure your agents are still someone who is maybe local, who can quickly act, talk with the doctors, make medical decisions for you. All
And
right.
with the Secure Act, if you have your trust as a primary or a contingent beneficiary, make sure that the trust is okay for it. It still makes sense for it.
That's right. Very important to do. Donna, we have about 2 minutes for you. I had a question in the chat and someone asked, can this backdoor be used when moving 401k funds? Because I know you had focused primarily on IRAs.
So it is, the short answer to that is no. Each 401k will have their own plan description and they have their own rules in a sense. The best way to do this is if you're ever changing companies or you've left the employer, you take that 401k, roll it over into an IRA, roll it over into an IRA, which is the same type of tax structure. And then we would have to convert it and convert it and such. There is something called a super backdoor Roth IRA that can be utilized in a 401k. It's a little bit more complicated, so I think maybe that's more of a question we can talk about off of the webinar, but just know that that is available. If you make contributions outside of the salary deferral, there's actually something we can do with that. I also received a question also, let me see, it says, will the backdoor Roth IRA result in separate accounts since each year an IRA to Roth IRA conversion needs to be made? Any way to get around that? So the answer to that is kind of yes, kind of no. It depends on how you're funding your IRA. If you're funding it as a lump sum and then converting it immediately, you likely have to open a new IRA every year for like 2 weeks. Just because most investment companies, if the balance is 0 for 90 days or 180 days, the account falls off. So you'll have to open it up a new one every year. But it really depends on which investment company you're working with.
Great.
All right. Well, I think that is all the questions that we have. I want to thank you guys very much for joining us. As usual, we appreciate your time. We always strive to provide content that's worthy of that. So we hope that you have found these webinars to be useful. A lot of you guys have already reached out to us with additional questions, and we love that. So please keep those coming. We know that our presentations contain a lot of info in a very short amount of time. So the recording is available to you on the website, usually the week after. We will skip December and resume back up in January. Our next event will be on Friday, January 15th at 12 o'clock. It'll be on New Year resolutions, as we'll be discussing some things you'll need to know to start the year off right. How to get organized with your finances, how to organize your taxes, what information should you tell your CPA, finally take care of some of those items on that to-do list. As usual, we'll post all of our events on Facebook, on our website, so please feel free to invite your friends and join us. You'll be receiving a survey shortly, so please respond so we know what kind of improvements we can make or any topics that you find interesting that we can address in the future. We hope everyone stays safe and healthy throughout this holiday season. Happy Thanksgiving, Merry Christmas, and we will see you next year. Stay safe, everyone.